As the video showed, and as Kyle mentioned, this is a really interesting time in real estate. It's a very interesting time to be covering real estate as a journalist. We're seeing a renaissance downtown, new housing, hotels, and offices popping up. Here in the western suburbs, we're seeing thousands of apartments being built, particularly around Jordan Creek, several new retail centers being developed, warehouses and industrial space popping up around the metro area. Young people are changing the face of real estate right now. They're putting off home ownership, they're demanding high-end apartments and new kinds of retail options. So it's a really interesting time to be writing about this industry, but I'm really interested in what you guys can share and your insights. So, as we mentioned, the local real estate industry is humming. Occupancy rates are up across many segments. Construction crews are breaking ground across the metro. I'm curious, in each of the individual segments you cover, what specifically is driving that? Let's start with the apartment market.
I would say the fundamentals of our market are historically strong and they're steady. So what's happened is people realize that, hey, we can go invest in Iowa and have a much more consistent return and stable product type than we can in some other markets. So that's one thing. The employers that Des Moines has and has brought in the last 10 years also contribute to the multifamily piece. We have a much more diverse group of renters than we did or have had in the past, and also a larger number of them.
And in retail?
Well, I'd look at a few things. If you look at a lot that's been written about Des Moines in general, the number of ratings that we've been top of class in, whether it be best rated place to raise a family, best place for young professionals, wealthiest city in America. A lot of those things catch the eyes of some of the retail groups. We've had great population growth in our market. We've had great growth in our spending power. The demographic overall, the incomes have continued to increase, and the unemployment has gone down. So all those things basically lead to, at the end of the day, more dollars in the pockets of our consumers. And more dollars obviously leads to more retail spending. You can take a look at the survey and see that the amount of money we surpassed $9 billion over the past year, which was a pretty impressive number. And I think you're going to see that trend continue. Gas prices obviously play into that. It just puts some more spending cash in the pockets of consumers.
All right, we'll get back to a few of those points. Linda, tell us about capital markets.
I will, but first I want to point out, some of you probably noticed this little cushion behind me. What I discovered when I came in, and I thought, well, I'm just going to sit in the chair and see how it fits. Well, if I didn't have this, when I sat back, my feet went up. So Kyle didn't think that would be very appropriate. So we hunted this tablecloth down. And so I think most of you know, Tim and I head up the capital markets group for investment properties platforms for CBRE. So we get to look at things that are happening nationally and compare it to what we see locally. And nationally, the economy continues to be strong. And when I say strong, although it fluctuates, we're much stronger than other local economies. If people look at that, we've had a huge flood of capital coming into the states. We're seeing that coming into Iowa as well because of the great returns that we have here. We've got about a 200 basis point difference in all asset types here in our metro market compared to throughout the rest of the United States, particularly on the coast.
And Maury, we've seen a number of warehouse and industrial properties break ground recently, several opening now. What are the factors that are attracting those developers to this area?
Well, I think the most prominent example of that would be Opus entering our market, constructing 2 speculative warehouses, one in Ankeny, about 208,000 feet, one in Grimes, about 180,000 feet. Our occupancy the past several years has hovered in the 3 to 4% range. With the addition of new product and some forthcoming vacancies, that is going to change over the next 6 months. It's going to become an interesting market, I think, largely to the benefit of tenants. To this point, most likely within the past 12 months, it's been a very strong landlord market, very few concessions. We're starting to see rate increases. I think it's going to be an interesting time here in the near future to see if that stabilizes or the trend changes.
Interesting. And we're seeing some new speculative office development. Tell us a little bit about what's driving that.
Yeah, the driving force of factors in the office growth is a combination of things, but one definitely is just growth, the growth of the employers here that are located here. Des Moines is extremely fortunate to have a lot of companies that are continue to grow and are expanding their office floor plate. And I think it's a little unique because in a lot of areas you hear a lot about companies that are fitting more people into smaller spaces and really kind of consolidating their footprint. But despite that, in the Des Moines market, in the past 3 years, we've had 500,000 square feet approximately of absorption, of positive absorption. So it's just the growth of the growth of our employers here. I think some other factors are you do have companies like, for example, Krause Gateway Center, Come and Go, or Merchants Bonding Company, companies that are, we've heard of the FC Stones movie. They're just upgrading their image, upgrading the kind of building that they're going into, and looking for new construction, new amenities, a lot of things that that millennial workforce now demands, and that's a driving force behind it also.
Very good overview of all the segments there. Now let's dive down a little deeper and take a look at a few different issues. Linda, I'll jump to you. I'm interested, I guess since today is Super Tuesday, people all over are headed to the polls. I'm curious about external factors, the presidential election, cheap gas prices, some turmoil in the stock market, issues in China, these cluster of external factors. Will we see any, do you expect to see any real effect in our local real estate market from those?
Let me start with the election process and what's going on now. I think we really haven't seen any change in what's happening in our market or even nationally in terms of interest in investment properties. And part of the reason for that, what you need to understand, is we've had a surge of capital, foreign capital coming into the United States. A great deal of that has been from China. Last year, 20% of the investment sales were by foreigners. And that's important to us because what's happening, and Manhattan has been one of the primary beneficiaries of the Chinese money, but they're also going to the West Coast. And what's interesting is they're not necessarily going to the coastal cities, they're going inland to some of the secondary markets. So what's happening is the competition with China coming in, and they don't care what the cap rates are. They just want a safe place to put their money. So they're paying these outlandish prices for properties, and that's pushing other institutional investors from the major markets into the secondary markets, where there's less competition from that standpoint. And then those private investors now are coming into all of the tertiary markets, and that's why we're seeing such a growing demand here in our marketplace. Our biggest challenge, not just here, but we see it in other parts of the country, is we don't have enough supply for the demand with all the money that's coming in. People look at this, real estate is really a safe haven for their money right now. When you look at the volatility of the stock market, bonds, where else are you going to put your money but in real estate? And so, as I said, our biggest challenge is getting enough product to meet the demand. And we do have foreign investors coming in looking in the market. We've been with Canadians, we've been with Greeks, we've been with some investors from Dubai, so they are noticing Des Moines as well.
Do you expect, you talked a little bit about the lack of supply, investment property owners here not really wanting to sell, wanting to hold on to their properties. Is there any reason to believe that's going to change in the near future?
Not really, not in the next, we figure, the next 18 months or so. This cycle is probably going to continue the way it has been. Now, obviously, there are reasons that people have motivated factors for selling. Our challenge is just finding out what those factors are and where those people are at.
And what's the profile of investment buyers looking here? Where are they coming from, and what is it that they're generally looking for?
I'll tell you, in the last 12 months, and this is the first time we've really seen East Coast money wanting to come into the Midwest. We've had a lot of people from New York and New Jersey in the market, but we're also seeing in areas like Minneapolis, Dallas, Chicago, and those surrounding areas, their cap rates have dropped to like 3 and 4%, particularly in the multifamily area, and so they look at our market and they think it's a real bargain if they can just find a property to buy. One of the other factors that I will mention that I think is important with regards to the election, depending upon what happens and who's in the White House, who's in Congress, many of you, I'm sure, are aware of the fact that there is conversation going on about like-kind exchanges, and changing them or eliminating it in its entirety. They're in the top 10 targets for tax reform. Last year, the last 5 years, I believe the number was $46 billion in value of tax-deferred exchanges. So you can understand why it's a target. But that would be absolutely devastating to our economy across the country. And you think of all the people that would impact, because people would be really reluctant to sell the properties, pay the capital gains. Once again, it affects real estate brokers, it affects construction, title companies, attorneys. You think about the widespread and the impact that would have.
All right, so a lot of investors looking at multifamily property. Tell us a little bit about that segment. We're seeing some 4,300 or so apartments in the works right now, maybe 3,000 of them opening in the coming year. Can we fill them all? Is there a demand to fill those?
Yeah, there is. Just to elaborate a little bit on what Linda said. The buyers that I see are primarily East Coast guys, or have been in the retail side of things, larger shopping centers, malls, that arena. And then my West Coast folks are in the apartment. But yeah, we have 3,000 units being delivered, of which will absorb within the realm of our market growth and what we can sustain. There's two areas where we have some concessions, some competing developments. The western suburbs in Ankeny is where I see those two specific niches, maybe a race to some of the stuff that's coming out of the ground this year to lease those up.
We're seeing some new types of products coming online downtown, townhomes, luxury apartments. So should we expect that region to continue to kind of lead rental rates in the metro?
Yeah, the rental market's shifting. You have, 10 years ago, you didn't have the millennial renters that didn't want to go from the newest loft to the newest loft. So you didn't have folks who were 65 years old that wanted to own a home that lived downtown Moines. So the spectrum of who's renting has gotten younger, it's gotten older. In downtown school, the partnership's done a great job. The social club, the employers of the big companies downtown have done a tremendous job of making Des Moines an awesome place to be, and all demographics are going to be down.
You mentioned millennials. We'll get to those later. Maybe everyone can vent. It might be kind of cathartic for everybody. So we'll get to that point later. Let's talk a little bit about the office. Yeah, jump in.
I think one of the questions that we're asked quite often is, are we about ready to have a bubble in multifamily? And our colleagues across the country are asked the same question. And I think an interesting fact that people should be aware of is that between 1995 and 2008, an average of 300,000 units were built across the country. In 2007, that dropped to an all-time low of 83,000 units. And then during the recession, there was not that much development that was going on, but the demand has continued to rise as there become more renters than house owners. And what they have projected, and this came from a research group, that if we continue at the level, in the last 18 months, the inventory, the supply has increased about 18 to 20%, and that's of the shortage that was created during the recession. If the same amount of units on average are built every year, it's going to take 13 years to get to the level where we should have been at had there not been a recession. Now, if that number goes up to about 500,000 units, they're saying it will take 9 years to create and get rid of that vacuum that had been created. They're projecting in 2019 that there will be 5 renters for every 3 households owners. And in another 20 years, 20 years ago, there were 2 times as many homeowners as there were renters. So you can see what's happening in the entire country.
Interesting. Let's jump to the office market. Bill, we talked a little bit about some of the small speculative office space that's being constructed now. It seems like downtown there's maybe some more subtle work going on in offices, a lot of renovation and updating. Tell us a little bit about that and how that's factored into the office market.
Yeah, if I was here, we were here 5 years ago, and we were talking about, hey, Bill, what do you feel about the downtown office market? I probably would have been pretty blown. But it's amazing where the downtown office market is today, and it's a mix of several factors. One is some of those older Class C buildings with smaller footprints floor plates have certainly been converted to multifamily residential apartments, and that has had a tremendous positive impact on the office market. But I think where we're seeing today, what we've seen now in the past couple of years, what we didn't see before, is you have some of the sponsorship and ownership of those Class B buildings. Even a building like A1 Grand, which is certainly Class A, could fit in this. But what they've done is they've gone in and remodeled and done some major overhauls of common areas and updated amenities. And if you're downtown and you see some of the work that Lawmark has done in the 500 Grand and Partnership Building and Financial Center, or what EMC's done to the Hub Tower, or even again what Principal did to 801 Grand, just improving that. These buildings show a heck of a lot better than they did, just a few years ago, and that's had a tremendous impact on occupancy rates. Occupancy rates are rising for the first time in a while. We're seeing lease rates start to rise, and it's really made downtown a viable solution. I could say it was rare when you had a company that would ever look downtown or west suburban. Usually they were one or the other. But it doesn't happen every day, but now you have some of the people you're working with that are willing to look downtown, willing to look, in addition to looking in the suburbs, where maybe they were only looking at the suburbs before. So that's exciting, and then you throw on top of that, you have a situation like Sherman Associates announcing they're building a new 73,000 foot building at Grays Lake. So you have speculative construction happening for one of the first time in a long time, and probably since Davis Brown was built. So it's very exciting, and I think to Ryan's point, there's an energy and excitement. I'm a person that's officed in both locations, and when you're downtown, there's just an energy and excitement to be down there. Something about being close to Court Avenue and the Skywalk system and what's going on with Gateway West, it makes it a real viable solution for people seeking office space now.
You mentioned companies that are taking a look at both the western suburbs and downtown. In the next decade, which region do you think fares better in terms of the office market?
I don't know if either of them are going to fare better than the other, but I can tell you, again, 5 years ago, I wouldn't have been as positive on the downtown, and I'm very bullish on the downtown now. I continue to see what's happened with East Village and the momentum there, and the kind of mix of office and retail that they've been able to accomplish in East Village, and we're seeing projects now open up downtown, and again, the capital investment that's been made by owners downtown. I think they're both going to be outstanding spots and a good place to park money for an investment.
Let's jump to industrial space. We talked a little bit about with the multifamily market, all the rapid construction we've seen. We've seen some of that in the warehouse market as well. A lot of new product coming online. Tell me a little bit about how much product we should have by later this year available, and what that will do to the industrial market.
Well, as I mentioned, Opus just completed construction of 208,000 feet in Ankeny and 180,000 feet in Grimes. They were successful in pre-leasing about 140 of the Grimes product. The remainder of their space is vacant. R&R recently completed their Prairie Business Park, their first building, 260,000 feet. They have about 160,000 feet remaining. You couple that with second and third generation space that will be coming online. We're going to see some opportunities here, and I think what it does is it's going to make landlords sharpen their pencil, take a hard look at rates. Again, there have been very, very few concessions the past 24 months due to the low vacancy.
And tell me a little bit about the kind of tenants that you're finding leasing these kind of warehouse distribution center type buildings more and more.
Well, an interesting aspect of that is the rise of entertainment. what I'll call sports venues to traditional distribution and warehouse. Examples would be Sky Zone at our Grimes Distribution Center, MB2 indoor go-karts in Grimes. We have a baseball, basketball training at our center, as well as volleyball. We just signed a tenant for a cheerleading academy. So the traditional tenants are still there and very active, but these entertainment venues are looking for economical space. Visibility is not necessarily critical. They are a destination. And again, for the sports venues, 24-foot ceilings, 32-foot clear, that's important.
Tyler, let's talk a little bit about retail. What type of space are you seeing the most demand for right now in the retail sector?
The biggest demand out there, really there's just no lack of supply for it, to be honest, is good, well-located Class A retail space. We are seeing some new developments scattered across various parts of the metro, and we're seeing rents in those developments at levels that a year ago I would have not thought we'd be able to hit those numbers. And again, it's just that simple supply and demand economics. But the main group that's driving that from my standpoint is some of these quick serve retailers and quick serve restaurants. If you look at the Chipotle's and the Jimmy John's and the Potbelly's, Hubbell's of the world, those type of retailers. The location for them is imperative to what they do. They need to be highly visible and highly accessible. And their competitors, there's just not a ton of differentiation in the products. Their competitors, if they're easier to find, easier to get to, they're going to get outpositioned. So there's been a huge demand. Rents, to give you specific examples, rents a year ago that we were seeing in the mid-20s a square foot triple net, I've seen jump as much as $10 a square foot and approach the mid-30s a square foot, which is, it's a heavy number, but I've got groups, in today's world that are willing to take a look at it.
What about the specialty grocers? We've seen several of those open up around here with a lot of fanfare. I think 3 on the west side specifically in the last year or so. Is that market tapped out? Do you expect to see more of that kind of development around here?
Yeah, I wouldn't expect to see any new players in that market, or I'd be surprised to, I guess. For a long time, it was a big push from everybody to get Whole Foods to our market. How do we get Whole Foods here? And Gateway started the trend. It did very well with their location off MLK. And we finally got Whole Foods to the market. And to follow them, we had a lot of people follow that trend. And that's not happening just here in Des Moines. That's happening nationwide. But, we've got, as I mentioned earlier, that consumer is a small segment of the overall consumer in our market. There's so many strong grocery players from Fairway to Hy-Vee. Hy-Vee is just a huge player in the market. And Hy-Vee is doing a natural product selection in their stores as well. But I think that segment of the market that wants that type of product, that natural grocery type of product, is starting to get chopped up pretty quickly. So I think the ones that know their product well, that have a good operation will be just fine. Some of the others may see them struggle a little bit.
One of the big stories in retail right now locally is the development of an outlet mall, Prairie Crossing in Altoona. How do you see that playing out in the retail sector? Will that cannibalize some retail on the west side? Tell me a little bit about your outlook for that.
Yeah, it's exciting to finally see that hopefully come to fruition. As I went back and looked, even from the time that Wayland first started with Bass Pro and that development, and how that's progressed over the years to then it being sold off to the company with the outlet plan was, I think I originally read where it was breaking ground spring of 2014, and now I read an article recently that it's breaking ground spring 2016. So I'm excited to see it actually come full tilt and actually come out of the ground. I think it'll be a good addition for our market. In lines of cannibalization, one thing that I would look at is there are a lot of stores that look at Des Moines and don't want to jump full on into the water, but maybe just dip their toe in it. And that gives them an opportunity to come in with, if you look at a Saks store, Saks on Fifth will come in with an outlet store and really just test the market and see how is our product received in the market, how are our sales versus some of these larger markets. So I think you may see that outlet center be a breeding ground for some national retailers that we all want to see in our market to really give them a springboard to start with an outlet and then transition into a full-fledged store.
An area to dip their toe in the market. What about, I'm curious, what's the retailer that people ask you about most? When are we getting a fill in the blank?
Oh, it's it's across the board. I think a couple years ago I had a slide up that talked about whether it be Louis Vuitton or Burberry or all these high.
Probably not very soon
high-end
with
groups.
either of those, right?
What's that?
Probably not very soon with those, right?
No, but it's funny how often they get brought up as these groups are going to come to Des Moines and even like an IKEA. If you look at what IKEA requires from a demographic standpoint in order to locate a store, we're not close to that yet. H&M is a big one I hear a lot about. I don't have any indication right now that they're going to make a move to the market. But they
Feel free to break some news
yeah,
today if you want.
they're sure talking about a lot. And I guess one thing that I would as a shopper is watch your mailbox a little bit. If you start to get advertisements from some of these groups, magazines, that's how they'll test markets a lot. Is they'll take online sales and look at the shoppers that go online. So you start seeing coupons from stores that encourage you to go online and buy. They look at what markets are they seeing the most online sales that they don't have a store, and that's where they start to look for to put a new concept.
Maury, we're talking about the kind of phase of a cycle that we're in. You talked a little bit about how the industrial sector might be in a little different phase than some of these others.
Well, the growth on the industrial side is going to be on the supply.
Or you eloquently said this earlier. I've never heard you be more positive when you said that this is going to create an opportunity. All of this space is going to
Tyler, there are no problems. There are just opportunities.
I like it.
And
I've always been a positive guy.
we're going to go from, just in reference to large blocks of space. And when I say a large block of space, I'm talking 50,000 feet and up. Right now, we have approximately 700,000 feet. By August 1, for one reason or another, that is going to grow to approximately 1.9 million. And again, these are large blocks of space, so we're not talking, the 10, 20, 30,000 foot user, but large space users are going to have some excellent opportunities. And it's not symptomatic of a poor industry or a poor economy. It's just, it's almost a perfect storm of new development coupled with some large tenants consolidating or moving to new facilities.
So is the region, I'll put it this way, is the region overbuilt when it comes to warehouse space?
Find out, aren't we?
No, I wouldn't say overbuilt. Last year, at this time, I predicted a vacancy rate that we are rapidly approaching. Again, we've had some new construction. It has not been overwhelming. It's quality product. It's going to make everybody sharper, and it's going to benefit tenants in the end. So, are we in a different cycle than other specialties? Certainly, but as time goes on, we're going to fill this space, and we'll be back in a low vacancy situation.
Let's talk about millennials, everyone's favorite generation. Pesky young people, I can say that because they have one. When they're not taking selfies or clamoring about food trucks or something like that, how is that generation affecting local real estate? Maybe I'll start.
If I could interrupt, I'd like to piggyback a little bit on what Bill was talking about. As far as amenities are concerned in the office market, I have a a logistics client who has a call center requirement that I'm working with now. And this has been an education for me. We're considering suburban and downtown office space. And what's critical is the typical employee of this call center is a 30 to 35-year-old college grad who may want to live downtown, may not, but all of the amenities, the fitness, dining, entertainment, to some extent childcare, are all playing into the decision-making, which is new for me. I mean, this is not my world. But I just wanted to echo what everyone else is saying about the growing importance of this population segment.
Well, it used to be with the before the millennials, let's put it like that what everybody wanted when they were looking for an apartment building was a pool and a clubhouse. Well, that's not what the millennials want now. They want cool wine cellars, they want dog sitters, they want dog runs, they want things that I never would have thought of. And I think they're really changing the dynamics of apartment living.
We're so needy.
You are.
On the office space side, it's really changed because now companies, the days of cookie cutter cube land in cookie cutter boxes, that's not what companies are interested in looking at now. Those cubicle walls are coming down. They're getting shorter and shorter. And now to market to their employees, they're talking about, their employees want to know about things like sustainability. They want to know what in their building workplace environment, what are you doing, what kind of water bottle refilling systems do you have? I mean, those are kinds of things that they're asking their HR departments now. They want to know about collaboration. They want to know, they want the walls coming down. They want to be able to talk to the people that they're working with on an everyday basis. They want to be able to move from desk over to a conference room to a desk and have that move happen without any trouble at all. They're interested in technology, having the utmost technology into the workspace. So these are all, technology, sustainability, collaboration. These are things that companies now, to Maury's point, that's what they're looking for in office space now. Their employees are demanding it. And so buildings, what we're seeing is there's building owners out there that have sensed this and they're reacting to it. And that's a real positive sign for our office market to have developers and owners out reacting to those needs.
These guys pretty much already said it. I think these guys, the millennials, impact everything that we do. They're the ones that are shopping online. They're the ones demanding new floor plans in your office space, in your apartments. Everything that we do from a renter's perspective, from people who are occupying real estate, is affected by millennials. Where they're not so impactful is on the investment side. They're not the ones that are out there driving cap rates. They're not the ones that are out there buying and developing. So it's an interesting dynamic that they're affecting, really what the end product is, but they're not the owners of the end product. They're not driving the demand.
They don't want to be the owners.
Right. They do. They want to lease space, and that's part of the attractive piece of what they're doing downtown. They want to go from the coolest building to the next coolest building. So.
Well, I'll touch on this before we have to go, but it seems like around the metro there still is a lot of land available for development. If you think about developments like Kettlestone, Joaquin, Grace Landing, downtown, Prairie Trail, and some of the development around Ryder Corner and Riverdale. As you look to the future, what do you guys see really driving the development in those areas where are seemingly primed for new growth?
On the office side, I'm really excited. We have 3 new spec buildings that have been constructed in the Moines Metro, and we haven't been able to see that for a number of years, and that's exciting. But when you add up that 180,000 feet in those 3 buildings, it's like less than 1% of our office market. Okay, so this is not a huge development. I mean, it's exciting. We want to talk about it. Hey, we got 3 new buildings, but it's a small. Our office development is still going to be driven by owner-occupied, build-to-suit, user-owner type buildings. Whether it be at Kettlestone or any of these areas, you're going to see buildings like Merchants Bonding, Come and Go. Those kinds of examples are going to be the driving forces of our office market. We'll see small projects that are speculative, but don't expect a rush of it. But these new areas that you're talking about, they're exciting. You will see some office development there. It's probably likely going to be very small speculative, or likely anything larger is going to be owner occupied or build-to-suit driven.
Kettlestone is an interesting development to look at. People are excited about it. They should be excited about it. It's a new interchange, and with that new interchange, it brings activity, whether it's hotels, restaurants, other retails. But I think one of the things that people don't always think about, and Tim and I have reflected back on Birchwood Crossing when Hubbell Realty Company started that project, what was it, 20 years ago, Rick? And we were so excited, and Tim and I were marketing and selling the land or whatever. It took 20 years to build that quadrant out. And it takes a long time in a market like this. And I think people just have to understand that. There'll be a lot of activity, but it's going to be over a long period of time.
On the industrial side, future development is going to continue to occur in Urbandale, in Grimes. There are still large tracts of land, some under contract, some owned by local developers, as well as I think the next major industrial corridor will be in Ankeny on Delaware. Toro has a 450,000 square foot distribution center. Boris new building just south of Toro. I think that growth is going to continue south. It's largely driven, I think, by the Corporate Woods interchange. The park is almost visible from Interstate 35, easily accessible. So I think Urbandale, Grimes, and Ankeny will continue to move forward on the new product side.
From retail's perspective, its main point comes down to rooftops. Anytime I work with a retailer out there, the first thing that we look at are traffic counts and rooftops demographics. I draw 1, 3, 5, and 10 mile ring and say, where are my customers at? Traffic is obviously important, but if you drive out to Waukee, Kettlestone, the interchange is open. Traffic is on the road. There's one retailer currently under construction. So the rooftops are so important to that, and Linda mentioned this with the amount of time it takes to build that out. It's going to take time for that area to fill in. So I would look at areas like even along Jordan Creek Parkway. You saw what happened with, it used to be called Michael's Landing, I forget the name of it now. But with that area really starting to fill in, you saw REI, Fresh Market, some of those groups come in. You've got some other retail developments in the works with Ryan Company's project that they're working on. I think that's where you're going to see. That's where you're going to see the majority of our new retail, and obviously with what's going on in Altoona that we talked about already, which is more of a, I look at that outlet mall as more of a regional draw. That thing's going to pull from 150 miles away, but it's going to take some time for Kettlestone to build some legs and grow up a little bit, and it's just that's part of it. And I think they understand that, but it's good. Timetables that I have in my mind would probably stretch a little bit longer than some I've seen.
Sure. And in the apartment market.
Yeah, multifamily development, all over the metro, there's opportunities everywhere. Over 1,000 units coming online downtown this year, 500 in West Des Moines, 400 in Ankeny. You've got over 200, I think 250 in Grimes. I see some great opportunities in some of the smaller markets like Altoona. If you look at the survey, you'll notice there's some gaps in rent on 2 and 3 bedrooms, particularly in some of the different markets where you can land's a little bit cheaper, you can go and build, and there's some upside in rents. The reason that Ankeny's been so successful is because most of their product type was really small, old, 1 to 2 bedroom units, and so this new construction has really challenged some of that product. In Altoona and Norwalk have some similar challenges, so some opportunities in some of the smaller markets. So growth everywhere.
Great. That sounds like a good place to leave it. So let's thank our panelists.